Thank you very much, Margaret, and thank you, Andrew and Jessica and everybody at 6 Meridian for having me. This is my first time in Wichita, not first time in Kansas. This is just fantastic weather. It's just great to be here with all of you. So as Margaret mentioned earlier, munis have been exciting. You didn't think I caught on to that. I grasp those moments because you don't get a lot of them. So I've, she was kind enough to go through my bio, and I've been in the muni market for about 35 years. So as most of you might imagine, at a cocktail party, I'm the guy, the muni guy over there. He's the one. So actually, it's been, and by the way, full caffeinated beverages are probably best for this window. It's actually been pretty exciting. And where we are today, what I wanted to do with our time this morning is just basically talk about, how we've gotten here, where we are today, where I think we're heading, and basically, what to do about it. And, before I can get into the munis, obviously, as Jordan was pointing it out and Stephanie was pointing out, there's a lot going on in the economy. There's a lot going on in the world. And, I think Jordan said he has someone who updates their slides daily. Well, that person's probably updating those slides hourly because you're getting headlines that are coming out, not just on tariffs, but other things, pulling tax-exempt status from universities, cutting aid to cities, all these different things that do impact the muni market, but not in a big material way as you might think. This may be news to people, but the media likes headlines that scare people. The reality is probably a little less so, a little less impactful. But what I would like to just start out by saying, muni credit quality is sound. There's nothing out there that's like, oh my goodness, what if this happens? What if that happens? Muni credit quality is sound. And you heard it from Stephanie, you heard it from Margaret, there was a lot of stimulus that came out of COVID. And it all went to the states and the local governments and towns. And guess what? They didn't need it. They adjusted their budgets for the worst possible outcome, that nobody was going to spend anything because of COVID. And then everyone stayed home. And the fear, believe it or not, the fear among muni research analysts during COVID was that all these states and local governments were going to do stupid spending with this stimulus money, that they're going to create future budget gaps. Thankfully, that didn't happen. They did spend up the money, and they did enjoy not having to scrape and balance their budgets, which states and locals actually do have to balance their budgets. They don't own a printing press like the United States, so they actually have to balance their budgets, which they do. But now you're back to a normal budget cycle, which means gaps open up and gaps need to be closed. It's never pretty. It's always ugly. It's always headlines. And those headlines are heightened right now because 46 states, vast majority, have a fiscal year that starts on July 1. So you're in the budget crunch cycle right now. So when you hear, California or LA County or, Chicago, it's always Chicago, you hear these headlines, you see these headlines, and you say, what about my muni bonds? We are back to normal. There's nothing harrowing in the muni market that I can see and I'm going somewhere with this, by the way. There's nothing harrowing that I can see that frightens me. I'm not worried about the tax-exempt status of these Ivy League institutions. It's very hard to do. There's a whole bunch of litigation. It's much easier to say it than to do it. So I am not concerned about that. As far as sanctuary cities go, pulling the aid there, yes, that can happen. But if you look at it as a percentage of their whole budget, it's actually pretty manageable. So you're also, think about it, you're not going to damage the blue states New York, Cal, Massachusetts, you're not going to damage them because you're going to damage the whole country. So yes, you can saber rattle a little bit and you can pull in a little bit on the margins, but it's not really going to be overly damaging. So the muni market, credit-wise, is actually in very sound shape. So, John, why is the muni market really lagging this year? Well, I can explain that. And like anything in the markets, there's a bid side, there's an offer side, and there's a great opportunity means things are really cheap. So those of you who own munis, I can explain. And those of you who don't own munis or maybe going to buy more, now is, in my opinion, a great time to put more money to work in munis because it's been a terrible time for the last couple of months. Why has it been a terrible time? And I have a couple of slides. I'm not going to get to them just yet, but I have a couple of slides, just 3 to show you. But the muni market is very seasonal. It's seasonal in supply. It's seasonal in demand. And normally, those two, optimistically, they would line up and things would be nice and smooth and lots of bonds would meet lots of money and so on and so forth. It doesn't work out that way. As I said, we're in budget cycle right now. Since most of the states have a July 1 fiscal year start, when they issue bonds, whenever they issue them in March or they issue them in October, they're like, oh, let's have July 1 maturity, which means July 1 coupon payments, semi-annual, July, January and July. So you have lots of money coming due in July, in June and July. You have lots of money coming due December and January, which is reinvestable cash. Now, what do these issuers do in the summer, and what do they do at year end? Well, guess what? They're normal people. They go on vacation, and they don't issue bonds. When do they issue bonds? March, April, May, September, October, November. When are the payments coming? July, August, January, February. So that you have a ton of bonds coming into the market and not a lot of money meeting them. And that was March, and that was April, and that's pretty much going to be May. So the muni market has actually lagged. On top of that, you have tariff announcements, you have treasury yields plummeted when stocks sold off, then stocks are recovering and treasury yields spike, and the muni market would follow that in sympathy. But then they say, oh yeah, but we got all this supply. And muni yields go up even higher, which frightens people because then they're like, what's wrong with the muni market? So like year to date, treasuries are up around just under 2%. Munis are up about 0.5%. These are through Friday night. So when does this end? Where are we at, and how did we get here? We were processing, as I said, all this stimulus money. The states didn't need to come to market with bonds for a number of years. Plus, you saw the inflation numbers from a few years ago. Rates were really high, so they're not going to borrow, and they didn't need the money. Well, now the money's kind of spent. The rates are down. They do need to borrow. So they've been coming in for the last over 10 weeks, $10 billion a week, new bonds coming into the marketplace. The normal week is about 7. So you have big weeks coming, right? A lot of bonds, that's pressuring the market. That was March, right? So we get to April, and everyone in the muni market's like, man, glad March is done. It's April 2nd, Tariff announcement. Treasuries go down, plummet, yields, and then spike. Munis do the same thing. And so one of those $11 billion weeks was right during this volatility. So all the underwriters who priced the deals said, we can't price a deal in this volatility, pull the deals. So 70% of the $11 billion got pulled and said, we're not bringing those deals. they get tacked on to the next couple of weeks, which are already 10 billion, 10 billion, 10 billion. So you have a 12, a 12, a 14. It's a lot of bonds in a time when people don't have a lot of reinvestment money, huge volatility, munis are lagging. It's just ugly. So that's how we got here. Right now, where are we going? And where we're going is, like I was saying, it's seasonal. We're going to get into the summer. We're in mid-May right now. You know, June is the biggest month from money coming due, maturing bonds, called bonds, coupon payments coming into everyone's accounts throughout this country. And what do people do? As Stephanie said, you get money, you spend money. They're going to be putting that money back into the muni market in June, July, August. You know what doesn't happen in June, July, and August? Supply. So you're going to have more dollars chasing fewer bonds, which means munis should catch up on their performance and perform very well in the summer. And then here's a spoiler alert. We're going to change it around again in September. So then there'll be less money and more bonds in September. So these cycles continue to go. So where does that leave us? And that'll bring me to my first slide. Why Parametric? That's a commercial. We're really big. We manage a lot of stuff. We are one of the biggest muni, separately managed account asset managers on the street, if not the biggest. So we do a lot of stuff. We have a lot of people. Okay. Why munis? Right? I just told you things are going to get better. Things have been lousy. It's not a credit thing. And by the way, interesting news, the budget reconciliation that just came out from Ways and Means doesn't include something that damages the muni market, because there was also this shadow, I didn't really talk about it, but there was this fear that in extending the Tax Cut and Jobs Act, that they're going to take a little bit off on the muni exemption, possibly cap it, possibly remove it. There was nothing in there that we could see that indicates that is going to happen. So here's the question, treasuries or munis? And what you have here, just with these three, this line graph here, you have the middle line is the U.S. Treasury yield curve. So that's the yields on the U.S. Treasury from 1 to 30 years. And like anything, if you invest further out, you want to get paid more for putting your money at risk all that time. So that blue line in the middle is the U.S. Treasury curve. The line below it, which I can't even tell what color that is, but the line below it, that's a tax-exempt muni yield curve, right? So what you see there is, it's a little tougher to see, but you see the muni curve is more of a trajectory going up as you move out to 30 years. So you start at 1 year and you kind of go up. Whereas if you look at the Treasury yield in the middle curve, you see you start going up little by little, fits and starts, you get to 20 years, and then it kind of flats out. And it actually inverts a little bit, it goes down. So the top line, which I always put in there, because no matter how much I talk about it, and that munis are tax-free, and it's a better deal for you, and the credit is really good, people look at it and like, yeah, those yields kind of I don't know. And I'm like, no, it's tax adjusted. That top line is tax adjusted. That does not include a state income tax at all, so it's very conservative. It's just federal top bracket, plus the net investment tax, which is also referred to as the Obamacare tax, 40.8%. So that top line is what you would need on a muni to match that treasury. And what you see is it's very steeply sloped. So that tells you a couple of things. In the front, it's kind of similar to treasuries, 1 to 5 years. 5 to 10 years. You look at that blue line, you look at that green line, it's still kind of similar. Then you get to 10 to 20 years. Look at the steepness of that green line and look at the flatness of that blue line. So if you're going to go out on the curve, you're going to put your money at risk for a longer period of time, you're getting higher after-tax yields in munis, and you're getting rewarded for, quote-unquote, extending out on the curve. Now, while I'm here on this one, a lot of people say, John, what are you going to get me in the muni yield? You're going to give me 3.5% out around there? And I'm, yes, that's actually right. It's tax-free, blah, blah, blah. They're like, yeah, fine. I can get today a 4% in treasury bills. And, that's pretty attractive. That really is. It was more attractive last year when it was 5%. It'll probably be less attractive next year when maybe it's 3%. And depending on what day you look at the street forecasts for what the Fed is going to do, and the Fed puts it in their dot plot, they're going to do 2 rate cuts this year is what they're saying. I think that makes sense to me. It'll be probably late in the year. But last month, whatever day you happen to look at these forecasts, it's between 1 and 4. So if things happen to start to slow up, maybe it is 4, and maybe that short rate goes to 3. The point I'm making is you want to lock in higher yields while they're here, because they're not going to wait for you to figure it all out and figure out tariffs and figure out what's going on. By the time things start slowing up, those rates will come down and you'll miss it. So they're like, oh, that's very nice, but historically, how has that worked out? Well, when the Fed has been starting a rate cutting cycle, which they started already last year, and it's kind of stopped right now or on hold, 4 out of 5 times an intermediate muni strategy and an intermediate corporate strategy outperformed a 3-month treasury bill, which were admittedly high at the beginning of these cycles. 4 out of 5 times, the intermediate, meaning 10 to 20 years, 25 years in that range, outperformed the 3-month treasury. But what happened on that one time when it didn't? That one time was coming out of the global financial crisis, when the spreads for all credit other than treasuries were distended. So if you look out 24 months from that, guess what? Intermediate, both muni and corporate, outperformed 3-month treasury. So as you will see 1,000,000 times, past performance is no guarantee of future results. So unlike everything, you do kind of learn. History doesn't repeat itself. It kind of rhymes, though. And you look at this, you say, okay, this seems like it makes sense. So I think right now it's a good time to extend out on the curve. But how really good are yields right now? Like, is it really worth it? Is today the day? Is now the time? Well, I just told you seasonally that it is. And these are 10-year muni yields, AAA, benchmark 10-year muni yields. No one quotes this as much as the 10-year treasury, but if you're a muni person and you watch this stuff every day, like I have for like 30 years, which I do not recommend at all, don't. Just read my stuff. It's, live your life. But if you look at this, like the joke, notice the chart goes up, the steps go up. We're at very close to the decade high, which was set just a couple of weeks ago. So from an absolute yield standpoint, this is a great time to extend out. Is it going to be a bumpy ride? There's headlines every day. Yes, it could be. Do we know for sure where it's going to go? No, we don't. But the street consensus view, which you can get on a Bloomberg terminal, it has like 25 plus economists around the street, and they take a consensus. Where do you think the 10-year treasury is going to be at year end, 2025? 413. Where are we now? We just clipped 4.5%. I think we're a touch below it today. I didn't check my terminal, but I think we're on a 447, 445, something like that. It's a pretty good time, even on treasuries. But what about munis? Because I keep saying, don't look at treasuries and make a choice on your munis. They're different markets. They're unique markets. The muni market is much less efficient. It's an inefficient market, which means if you know what you're talking about, it's opportunity. So we're already at near the decade highs, which were reached and set new just a couple of weeks ago. So what about versus treasuries? Relative value versus 10-year treasury. the last couple of years, right? So all this simply is your muni 10-year tax-free yield divided by the 10-year treasury yield. And normally, in the last 2 years, it's been about 66%. Right now, it's about 76%. This is a couple of days old, this slide. But point being, it's the highest. It's near the high that it's been in the last couple of years. And another thing, people say, oh, well, John, I happen to know, because I know a lot of you are big muni people, so you just say, John, the long-term average is 83. Everybody knows that. They don't. But the long-term average over like 40 years is 83. So why are you telling me 75 is good? Here's why. Over the last 40 years, Treasury market has grown immensely. There's going to be treasuries forever. We're never going to have supply problems in treasuries. And the corporate market has grown exponentially. The muni market has been treading water for like over 20 years. It barely grows. In fact, we have months that, depending on how much money is coming due, being to coupons, called bonds, maturities, we have months that are net negative versus the amount of supply that's coming in. And we have months that are net positive, meaning more supply versus what's coming due. So the muni market pretty much treads water on a year-to-year basis. Why? Because they have to balance budgets. Goes back to they have to be prudent spenders. You may not think that, depending on the headlines, you may not think that, but versus the federal government, they're prudent spenders for sure. So that muni market hasn't grown, which means when you compare a small market to a big market, there's a scarcity value. And that scarcity value supports a lower, what we call muni rel-val ratio. And that is why like 75, 76%, that's really, really good. The low was a couple of years ago, 55%. And if you're in a 37 bracket, then, anything above 63% really should make sense to you. And I'm throwing around a lot of percentages, but the bottom line is, note that chart goes up. You are here. So it's a very good time to be adding to muni portfolios. It's a very good time to be, starting muni portfolios. Like I said, we do separately managed accounts. Separately managed accounts give you a tremendous amount of flexibility. You can pick a ladder, usually is one of the most popular ways. And like I was saying on that prior slide, with that curve, where would you want to be? Would you want to invest on the flat part, be like 1 to 5? Not especially. Would you want to be 5 to 10? Not especially. Where does the action really start? It's 10 to 20. And then even in the muni curve, it kind of flattens out a little bit. So if you're investing in that 10 to 20 steep trajectory, you're getting paid incrementally to go out on that curve, which makes a lot of sense. So, where do I see us going? Just in the future months, I think you're going to see munis catch up and outperform, and catch up to treasuries and corporates. But the name of the game in munis is not so much outperformance and making gains. You don't want to have losses, but believe it or not, most muni investors, they would rather have losses than gains. Sounds kind of ridiculous, but why? Well, one, you don't want to pay ordinary income tax. You don't want to pay capital gains, but you definitely want tax-free coupons that you don't have to pay any interest on. So investors are more likely to put more money in munis when they're down than put more money in munis when the yields are lower and the prices are higher. And with munis, you can do tax loss harvesting. And Parametric, I almost said Morgan Stanley. I've spent my life at Morgan Stanley. I'm the oldest rookie that Parametric's ever had. I'm 2 years with Parametric. I'm a lifer at Morgan. Tax loss harvesting in munis is a huge thing because you can sell your munis, buy a similar but different for the IRS bond, and then take that loss and apply it to gains elsewhere in your portfolio, assuming there are such gains, or even ordinary income, and you can carry them forward. So muni investors are very, very much involved with tax loss harvesting. It's something Parametric excels at. We do it. We're best at it in the street. And trust me, when I became a portfolio manager 8 years ago, I never said, I can get you losses. It's not where I thought I was going to be. I was also thinner. I had a lot of hair. So this is not where I thought I was going to be. But this is a clean market. It's a very repetitive market. If you do it right, if your portfolio is done right, which is the only way we build them, it's supposed to be really boring. You're supposed to just get checks and really not worry about it. It's been a little crazy with interest rates going up, in 22 and 23. It was really tough in 2019, 2020. I think you're getting to a more normalized period where you can have a good portfolio, AA average, clip your coupon, live your life, learn to play the piano, play golf, whatever it is. You don't need to be riding a roller coaster. And the muni market is a pretty quiet, stayed and true type of marketplace. It's funny. I'm doing this over 35 years. I've seen a lot of cycles. My bio gets shorter and shorter the longer I do this, because I think people just are like, yeah, whatever, he's the muni guy. So I've been called a lot of stuff over the years. I'm a New Yorker, so most of it's good stuff. But muni guy is something I've kind of like, that suffices. So if any of you have any questions going forward, obviously, talk to 6 Meridian. We'll get you answers. Can I answer any questions right now? Anything muni related? Do I have time for a question? I have 5. Okay. Question that's under 5 minutes for me to answer. Is there concern about the muni tax exemption ever going away? The answer is yes. In fact, all the muni nerds this year, that consumed a lot of our time. In fact, I was at a conference just a couple of months ago called the Muni Buyers Conference. So all the asset managers, all my peers, all my fierce competitors, we all get together, we check our weapons at the door, and we talk about what's facing the industry and best practices. It's actually a very cool thing. The muni market is a very unique community. We all kill each other day to day, competitive-wise, but we're all friends. We all know each other. And that was a number one topic, because with the extension of the Tax Cut and Jobs Act, obviously it costs money. You need to pay for things. And one of the things, whenever there's tax reform, the tax exemption is always like, oh, maybe we'll cap it, maybe we'll limit it, maybe we'll eliminate it, maybe we'll get rid of it for higher ed and hospitals, which was in scope this time round. But like I said, the Ways and Means that just came out, that budget reconciliation, doesn't appear to have anything in there. I mean, there's a ways to go here, but that was a concern. During the Obama years, they actually put limiting the tax exemption in their budget. It went nowhere for a couple of years. And that relative value ratio that I told you is pretty good at 75, the market had a heart attack. That ratio was like 120%, which at that time, all the muni strategists, including this guy, was screaming, you need to buy this. The muni exemption is beyond free. You're supposed to buy it. It's a great opportunity. And it was. But that was then. Here we are now. It doesn't look like that's going to happen. And just to answer the question, yes, they can do that. Because until 1986, they couldn't. But there was a court ruling in 1986, the federal government can pull that muni exemption. So it can happen. Doesn't seem like it will happen. If it does happen, don't sell your bonds. In fact, probably buy more, because the strong expectation, which I agree with throughout the street, is the outstanding bonds would be held harmless, grandfathered, meaning they'd probably be more valuable after than they would normally anyway, because they're not making them anymore. They become museum pieces. So they're pretty unique, pretty valuable. So if you get headlines like that, don't dump your bonds, don't sell into it. It's very, very likely that that's my opinion. It's very likely that they would grandfather them. The outstanding bonds would be held harmless and actually trade a little bit stronger. So thank you very much for your time. This has been really exciting, and anybody who wants more of this excitement, I'll be front and center here. Thank you so much for your time. And Margaret, thank you.